Imagine checking your company's bank account, right? You see this massive pile of incoming cash, but
Yeah.
then your accountant taps you on the shoulder and says, you actually just suffered a devastating $394 million net loss.
Oh, man. Yeah.
And not only that, but Wall Street is completely panicking because you missed their earnings estimates by this staggering 613%.
Right, which sounds apocalyptic.
It does. But then your management team is somehow popping champagne because they're celebrating a 13th consecutive quarter of positive operational cash flow.
It just sounds like a complete breakdown in financial reality. I mean, you have two completely opposing truths existing at the exact same time.
It really does. But, that is the exact puzzle we are taking apart today. Welcome to the deep dive, where we are opening up a massive stack of financial research, specifically the Q1 2026 financial valuation analysis of Coinbase Global.
Yeah, and it is quite the puzzle.
Our mission for you today is to guide you past these terrifying headline numbers so we can uncover the actual engine running this company in mid-2026. We are going to figure out if this business is, a hyper-growth tech anomaly, a reliable cash cow, or maybe just a highly volatile casino.
Definitely a lot to unpack there.
For sure. But before we figure out how a company can bleed millions on paper while basically swimming in actual cash, I need to share this required focus message with you. To access more advanced researches, applications, and our latest personal deep value agents, welcome to explore and join deepvalues.ai app. Track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice. Conduct your own due diligence before making investment financial decisions. Don't forget to like this video. Much appreciated.
Okay, so the key to unlocking this entire mystery, it really starts with understanding a massive disconnect between standard accounting rules and, well, the physical cash a business actually generates.
Right.
That friction is the sole driver of the chaotic narrative surrounding their Q1 2026 earnings report.
Let's actually look at those Q1 numbers, because if you only read the top-line summary, it looks like an absolute disaster. I mean, they reported an earnings per share, an EPS of negative $1.49.
Yeah, and analysts were expecting.
Positive 29 cents, that is the massive 613% negative surprise driving all those headlines. And on top of that, revenue dropped 21% sequentially, down to $1.41 billion. So anyone just glancing at their brokerage app would think the underlying business model is fundamentally failing.
And that assumption is completely wrong, because the culprit for the massive net loss has basically nothing to do with their day-to-day operations. The real culprit is just an accounting mandate.
Right, the FASB rule.
Exactly.
Yeah.
Specifically, the FASB Accounting Standards Update 2023-089.
Let's break down the mechanics of that rule, because I know accounting jargon usually puts people right to sleep, but here it's actively distorting a multi-billion-dollar valuation.
Yeah, it really is. So this specific rule forces companies that hold proprietary crypto assets on their balance sheet to measure them at continuous fair market value.
Which they didn't have to do before, right?
Right. Previously, companies treated these assets more like intangible property. So you only recorded a loss if the price dropped, but you couldn't record a gain until you actually sold the asset. But now, every single quarter, the company has to take the current market price of Bitcoin or Ethereum and mark their holdings to that exact price.
Okay, so if the whole crypto market tanks.
The company is forced to record those paper losses. Those unrealized mark-to-market losses go directly into their net income on the official income statement.
So, okay, let me try to put this in perspective. It's essentially like if your local housing market dropped by 20% in a single month, your house is suddenly worth way less on paper. But then your accountant tells you that your actual monthly salary from your day job is now negative.
Yes.
Even though your employer still paid you, the check totally cleared, and you put fresh cash in the bank.
It's a brutal reality check for anyone just reading a standard balance sheet. And, that 20% housing drop analogy is quite literal in this scenario.
Wait, really?
Yeah, during Q1 2026, the broader cryptocurrency market experienced a pretty widespread downturn. The total market capitalization dropped by more than 20%.
Oh, wow.
So this massive pile of assets that Coinbase holds on its corporate balance sheet just plummeted in value, forcing them to write down a massive accounting loss. But if we strip away the paper losses and just look at the actual operational profitability.
Like the physical cash coming in from users.
Exactly. They achieved a positive adjusted EBITDA of $303.3 million.
And just for clarity, adjusted EBITDA being earnings before interest, taxes, depreciation, and amortization. Basically, it's a metric that strips out all those non-cash expenses to show what the core business engine is actually pumping out. Right.
Right. Generating over $300 million in positive operational cash while the underlying asset market drops 20%. That is incredibly resilient.
Yeah, it really is.
And what's fascinating here is that it creates this phenomenon we call optical volatility.
Optical volatility, I like that.
Yeah, to a casual observer or, some algorithm scanning news feeds for negative numbers, a $394 million loss triggers a massive sell-off. It scares retail investors away. But for institutional analysts looking deeper, it proves management has built a business model capable of generating positive cash flow across brutal market cycles, even surviving that mid-2026 tech-led market sell-off.
The market certainly reacted to the optical volatility, though. I mean, the stock dropped to around 196 after hours, and then it drifted all the way down toward the 140 range in the following weeks, pretty much driven entirely by that negative sentiment.
Yep. It was a steep drop.
But it brings up an underlying mechanical question for me. If the total crypto market cap dropped 20% and their retail trading revenue dropped 21% right alongside it, how on earth did they still generate that $300 million in operational cash?
That is the big question.
Because if retail users are fleeing the market, that transaction revenue is just gone. They must have built an entirely different engine under the hood.
They did. Because that core retail volume is incredibly cyclical, management realized a long time ago they couldn't survive purely as just an exchange. They had to transition into what they are now calling the everything exchange.
The everything exchange.
Yeah, they were basically building an invisible financial infrastructure to replace those lost retail trading fees.
An invisible infrastructure. The sources highlight that their modern revenue mix has radically shifted. Transaction revenue from retail users, like the people logging onto their phones to buy $50 of Bitcoin, that only makes up about 45% of total revenue today.
Which surprises a lot of people.
I think the average person assumes Coinbase makes like 99% of its money just by taking a slice of every retail trade.
Oh, absolutely. But the other 55% is this heavily diversified category called subscription and services, and honestly, it is the entire key to their survival.
So what's in that 55% bucket?
Well, about 20% of their total revenue now comes from stablecoin revenue.
Okay.
Coinbase has this partnership with Circle to manage the USDC stablecoin. So when people buy USDC, the actual US dollars backing that digital coin are deposited into traditional banks, or they're used to buy treasury bills. And Coinbase earns massive, predictable interest yield on those fiat reserves.
That is actually fascinating. So they are essentially functioning as a modern digital bank, just collecting the risk-free rate on billions of dollars of customer deposits backing the stablecoin.
Exactly that. It's brilliant.
Yeah.
And then another 15% comes from blockchain rewards and staking. This is where users lock up their crypto assets to help secure underlying networks, like Ethereum.
Right, and they get a yield for that.
Exactly. In return for securing the network, the protocol pays a yield, and Coinbase takes a commission just for facilitating the process. Then, roughly 10% comes from custodial fees, literally just charging massive institutions to securely hold their digital assets. And another 10% is institutional transaction revenue, functioning basically as a prime brokerage where they act as the primary concierge and clearinghouse for hedge funds.
The scale of this transition is staggering when you actually look at the 2025 milestones in the research. Like, total trading volume hit $5.2 trillion.
It's massive.
But the statistic that really forces a double take is that they now have 12 distinct product lines generating over $100 million a year, and 2 of those products are exceeding $1 billion annually. And a massive piece of this is their custodial dominance, right? They are now the official custodian for over 80% of all the spot Bitcoin and Ethereum ETFs in the United States.
Yeah, and that 80% market share is a nearly insurmountable hidden moat. It means that even if a traditional investor completely ignores Coinbase and they just buy a standard ETF through a legacy Wall Street broker like Fidelity or Charles Schwab.
Which a lot of people do.
Right. But that broker is essentially relying on Coinbase's underlying infrastructure to hold the physical asset anyway.
But the infrastructure play goes even deeper than holding assets. The sources dive heavily into their proprietary Layer 2 blockchain, which they call Base. For anyone listening who isn't steeped in crypto architecture, think of the main Ethereum network as this heavily congested, expensive toll road.
Good analogy.
Yeah, and Base is essentially a private, high-speed express lane that Coinbase built directly on top of it, making transactions incredibly fast and costing only fractions of a penny. The research notes that Base saw 10x year-over-year growth. But here is the detail that legitimately blew my mind.
What's that?
Base captures over 90% of emerging AI-driven agentic commerce volume. We are talking about non-human AI programs transacting with each other, and they are using Coinbase's network to do it.
The implications of that are just massive. As artificial intelligence agents begin executing tasks, booking flights, buying data, reserving server space, they require a financial settlement layer that moves at the speed of the internet, not the speed of traditional banking.
Right, because traditional banks are closed on weekends.
Exactly. So they use the base network. And every single time these AI agents make a microtransaction, Coinbase acts like a digital toll booth operator. They collect a microscopic network sequencing fee just for ordering the transaction on a blockchain. They are basically embedding themselves at the foundational level of the decentralized web.
It is so brilliant to essentially tax the machine-to-machine economy. But let me push back on this broader ecosystem for a second, because the traditional finance world is not just going to let them take over without a fight. You mentioned retail trading still makes up 45% of their revenue. TradFi giants, like Robinhood or Interactive Brokers, they are aggressively pushing into this space.
Oh, heavily.
So if the legacy financial system establishes a standard of zero-fee crypto trading across the board, won't Coinbase's 45% retail fee engine just stall out and completely die?
That is a highly documented secular fee compression risk. The premium spreads they charge everyday retail users will inevitably compress towards zero as competition increases. But that existential threat is the exact catalyst driving this everything exchange pivot. They know they can't outrun gravity on retail trading fees.
So how do they replace a revenue stream that currently accounts for nearly half their business before it completely evaporates?
By moving super aggressively into complex institutional products and foundational infrastructure. They recently purchased a strategic stake in Deribit, which is the undisputed global leader in crypto options trading, and that allows them to capture institutional derivatives volume. They are launching unregulated prediction markets.
Right.
And, like we just discussed with the base network, they are shifting from taxing a user's trade to taxing the underlying execution of the global digital economy itself.
Replacing a retail trading app with the underlying plumbing for a new global financial system is an incredibly heavy lift. And building that kind of infrastructure while fighting off traditional banking monopolies, it requires a very specific, almost combative corporate culture.
It requires a leadership team willing to operate offensively. They have to build massive, intricate regulatory walls to protect this new infrastructure while it actually scales up.
The sources describe the executive trio, so that's CEO Brian Armstrong, CFO Elijah Haas, and Chief Legal Officer Paul Grewal, as taking a militant stance on regulatory advocacy.
They are just sitting in Washington quietly lobbying lawmakers, right? They are actively taking global regulators to court.
And their aggressive 2025 track record proves that litigation strategy is actually bearing fruit. They officially secured the markets in crypto assets, or MiCA, license in the European Union.
Which is huge.
It is a monumental regulatory victory because it grants them passportable access to all 27 EU member states. It basically allows them to systematically conquer international market share while completely sidestepping the political gridlock in the United States.
But they also secured a massive victory on their home turf, too. In February 2025, the SEC lawsuit against them was dismissed with prejudice. The financial analysis highlights that this dismissal removed a massive valuation overhang that had been suppressing the stock price for years. Yeah, and removing that overhang really solidified their compliance mode. To operate a fully compliant licensed exchange globally requires maintaining over 80 different regulatory licenses. The structural overhead to support that compliance is just staggering, but it means the barriers to entry for any new startup trying to compete with them are now astronomically high.
The financial burden of maintaining that moat is incredibly steep, though. Just looking at the Q1 2026 breakdown, they spent $525.6 million on technology and development, and then another $376 million on general and administrative costs. You're looking at practically $1 billion a quarter just to keep the lights on.
Right, and that's driven by elite engineering talent, cybersecurity, and those massive legal frameworks we just discussed.
It is an incredibly high fixed cost base, but a defining characteristic of this management team is their radical transparency regarding operational risks. Look at how they handled the 2025 data breach.
Right, that was the incident where malicious actors gained unauthorized access through third-party contractors.
Yeah. And historically, major corporations attempt to bury or downplay data breaches for as long as legally possible. But this management team took the exact opposite approach. They immediately filed an 8K, which is an emergency corporate disclosure with the SEC.
Yep, no hesitation.
They voluntarily accrued a massive liability, estimating between $180 and $400 million to proactively reimburse any affected customers out of their own pocket. They confronted the financial impact head-on without trying to, massage the narrative for investors.
They certainly control the narrative, but from a corporate governance standpoint, retail shareholders are essentially just passengers on Brian Armstrong's ship. The research details a dual-class share structure, where the Class B common stock, which is held tightly by the founders and early venture backers, carries 20 votes per share.
Right. So when regular shareholders try to introduce proxy votes demanding pay transparency or AI data oversight,
The founders just deploy their 20x voting power and veto it.
which is wild, how does traditional Wall Street tolerate what is effectively a Silicon Valley dictatorship?
Well, Wall Street's tolerance makes complete sense when you look at who actually holds the majority of the publicly traded stock. The top institutional shareholders are these massive passive mega funds like Vanguard and BlackRock. They acquire enormous tranches of equity just to fill their index funds and ETFs.
Okay, so they aren't actively trying to manage the company.
Exactly. These mega funds actually prefer the dictatorial voting structure because it completely insulates the company from short-term activist investors.
Oh, I see. So by holding absolute voting control, the founders can execute a 10-year vision without waking up to find a hostile hedge fund demanding they sell off the custody business for a quick quarterly profit.
Precisely. It allows management to protect the original cypherpunk ethos,
Mhm.
the foundational belief in cryptography and decentralization, while still maintaining the aggressive regulatory posture that secures their compliance mode. An offshore competitor can't easily replicate an infrastructure protected by both a fortress balance sheet and an unassailable leadership team.
Which brings us to the ultimate question for anyone looking at the raw financial data. So we have a company generating substantial operational cash flow, but it's hidden beneath accounting illusions. They are successfully shifting to a diversified everything exchange to outrun fee compression. They possess a fortress balance sheet, literally sitting on $11.3 billion in cash and equivalents at the end of 2025.
Hmm.
And they are governed by heavily entrenched management. But how do you actually assign a value to a company that operates like a massive tech monopoly in a highly volatile sector?
The valuation debate is deeply polarized. If you hand these financials to a traditional deep value analyst, someone applying the classic principles of Benjamin Graham or Peter Lynch, Coinbase fails almost every single fundamental test.
The traditional metrics are definitely stark. Like a classic value investor generally looks for a price to earnings or PE ratio sitting comfortably under 15. But best on the trailing 12 months leading into Q1 2026, Coinbase's PE ratio is sitting at an astronomical 64.53. The price to book ratio is 3.83, well above the traditional 1.5 standard. And their earnings remain heavily cyclical, swinging wildly based on macroeconomic crypto sentiment.
A traditional value investor sees those multiples and immediately walks away. But thematic value investors see an entirely different landscape.
Like Cathie Wood and ARK Invest.
Yes, exactly.
The sources show her strategy relies heavily on buying systemic panic. When the stock plunged toward the 140 to 150 range following that Q1 earnings headline miss, ARK didn't wait for a traditional PE ratio. They immediately deployed $43.5 million to buy the dip. They view the current price as a deep value play relative to the sheer size of the future global digital economy.
And to bridge the gap between traditional and thematic investors, the research actually provides a detailed discounted cash flow, or DCF, analysis. A DCF attempts to calculate the intrinsic value of a company based on the cash it will generate in the future, discounted back to today. But to account for the extreme cyclicality of the crypto market, the analysts normalize the cash flows over a 10-year cycle.
That makes total sense. Because if you build a model using only peak bull market euphoria or deep bear market despair, the math is just completely useless. You have to smooth out the extremes. The model uses a normalized trailing 12-month free cash flow of $2 billion.
And we also have to factor in how they are deploying that massive free cash flow. A critical piece of their capital return strategy involves share repurchases. Over 2024 and 2025, they spent $1.7 billion buying back 8.2 million shares. And in January 2026, the board authorized another $2.0 billion for repurchases.
Why aggressively buy back shares instead of paying a dividend or acquiring more companies, though?
Because of that massive structural overhead we discussed earlier, they distribute over $800 million annually in stock-based compensation to retain elite engineering and legal talent. If they don't buy back shares.
That constant issuance heavily dilutes the existing shareholder.
Exactly. By deploying billions into repurchases, they execute a classic mega-cap tech playbook. They absorb the dilution of employee stock grants so the underlying value of each share isn't eroded.
Okay, so with the $2 billion in normalized free cash flow and the massive buyback program acting as a shock absorber for dilution, what does the actual DCF model calculate for our per share value?
The analysis models two distinct scenarios. The first is a no-growth scenario. This assumes the cryptocurrency market has permanently matured, innovation stops, and transaction volumes stabilize forever at 0% growth. Under that super pessimistic assumption, the intrinsic value of the stock is calculated at $80.34.
Considering the stock was hovering near $196 during this reporting period, a zero growth reality means the company is massively overvalued.
It is, but the second scenario is the nominal case. This model assumes the everything exchange pivot is successful, the base network captures a massive share of developer and AI activity, and they achieve a healthy historical average free cash flow growth rate of 15%. Under the nominal scenario, the intrinsic value per share jumps to $177.1.
Okay, so let's synthesize what this math actually means for you, the listener. If the nominal intrinsic value is calculated at 177 and the stock is trading on the open market at 196, it means you are paying an 11% premium right now.
Right.
But a fundamental tenet of traditional value investing is demanding a 30% margin of safety. To achieve a 30% discount on an intrinsic value of 177, you'd have to wait patiently for the stock to drop down to around $124. So are we essentially trying to measure a futuristic spaceship with a wooden ruler by applying 1950s value investing math to a decentralized infrastructure company?
That is the exact friction point of this entire analysis.
Yeah.
Investors willingly paying $196.86 a share are not buying the current cyclical earnings profile. They're entirely ignoring the PE ratio. They are purchasing a high-margin call option on the total digitization of the global financial system.
They believe Coinbase will inevitably become the foundational plumbing of the future economy, and they are willing to pay a premium today for a monopoly tomorrow.
Yeah, it basically functions as a cyclical growth compounder, not some distressed railroad stock from Benjamin Graham's era. The business possesses massive operating leverage. When macroeconomic conditions shift into a bull market, their revenue scales exponentially, while their fixed engineering and legal costs remain relatively stable, causing profits to explode.
But capitalizing on that leverage requires immense patience.
Absolutely. An investor has to be willing to endure the optical volatility of those FASB accounting rules during the inevitable downturns.
So let's recap the journey we just took through this massive stack of financial research. We started with a riddle about a company reporting a devastating $394 million loss while simultaneously celebrating positive operational cash flow. Now, you know how to look straight past the FASB 2023-08 accounting illusions to see the actual physical cash the business is generating.
Yeah, it's a huge distinction.
You understand the astonishing scale of their everything exchange pivot, collecting yield on billions in stablecoins, vaulting 80% of US spot ETFs, and building the base network to capture the emerging AI agent economy. And finally, you see how the stock's valuation is priced for massive future expectations, requiring an investor to look past traditional margins of safety and bet on the long-term digitization of finance.
They are a company actively attempting to engineer the architecture of their own future. But if we step back and look at the absolute long-term trajectory, there is one final lingering paradox that the financial models don't explicitly resolve. It is a classic innovator's dilemma playing out in real time.
An innovator's dilemma implies they are creating something that threatens their own survival. What is the paradox?
Well, the company is aggressively spending billions of dollars to build the base network and promote the widespread adoption of decentralized finance, or DeFi. The entire philosophical and functional point of DeFi is that users transact in a completely trustless environment, peer-to-peer, without ever needing a central middleman.
Right. The technology guarantees the transaction, so a bank or a broker becomes entirely unnecessary.
So here is the dilemma. If Coinbase is completely wildly successful in their mission, if they build the perfect infrastructure that makes the entire financial world decentralized, trustless, and peer-to-peer, do they eventually disintermediate their own wildly profitable centralized exchange?
Wow.
If no one in the world needs a middleman anymore, what ultimately happens to the world's most successful middleman?
They are pouring billions into building the exact infrastructure that could theoretically make their core business completely obsolete. That is a phenomenal paradox to mull over as you watch this industry evolve over the next few years. We started today trying to understand how a headline loss could hide a massive cash engine. Now you know that in the complex world of modern finance, the most critical numbers and the biggest risks are always hidden beneath the surface narrative. Thank you for taking this deep dive with us.